Thank you very much indeed, Alexandra and company. We have one more panel before the promised land that is lunch. It asks the question of squeeze, middle, or the centre of the action, the mid-market and growth capital in changing times. To oversee proceedings, it's my great pleasure to introduce Olga Parfiryeva, Senior Associate, Product and Market Development, EMEA, S&P Global Market Intelligence.
Excellent. Thank you very much, team, and welcome to my esteemed panelists who join me today on the last panel before lunch. I know how exciting that is. Before we dive into really answering the question, is it a squeeze middle or is it the center of action, there are a few housekeeping points that I'd like to point out. You are able to post questions to the panel outside of what I'm going to ask them. If you go to slido.com, #BVCA, and then you choose the main plenary, and there you can submit your questions. On the same note, we do have a polling question before we begin, so we'd like to get your opinion on what is the mid-market to you. So if you can take some time now and go to slido.com to answer that question, and I'm going to let my panelists to introduce themselves. So really quickly, a few notes about yourselves. What are your funds do? What strategy? What type of investments?
Okay, good afternoon. I'm Merrick, McKay, head of the private equity activities at Aberdeen Standard Investments. We're an LP investing globally, but within Europe we have about 8 billion euros of AUM across primary, secondaries, and co-investments. On the primary side of things, we make about 10 to 15 new commitments a year for multiple strategies, and we invest from everything from first-time funds through to the CVCs and advance the large end.
Hi, good afternoon. I'm Oliver Wyncoll from Bridges. We're an impact investor. We manage about $1 billion of funds across 15 different entities, but 3 strategies: real estate, social sector, and the funds that I manage, which is in growth companies, sustainable growth companies. We're taking control investments in fast growth but impact-centered businesses where we're looking to drive financial return at the same time as impact returns in society or in the environment.
My name is Sean Dinnen. I'm managing partner of CBPE. I always call us unashamedly low in mid-market. We may debate the definitions. To me, that means businesses with an enterprise value of between 25 and 125 million. Typically, in EBITDA terms, that's a minimum of 3 up to 15 at the point at which we invest. We're currently investing from a 459 million sterling fund that closed 2 years ago, and we've made 5 investments from that fund so far. Interestingly, none in the last 12 months. If you look at our record since our former parent, Close Brothers Group, entered the buyout business, we've invested in 46 businesses, over 3.5 funds, sold 37, and those 37 have returned 2.7 times capital realized on those investments.
Hi, Nicki Boyd, founding partner at Apiary Capital, new lower mid-market private equity firm. We closed our debut £200 million fund in July this year, and shortly after announced our first investment. We're investing in service businesses in the healthcare, education, and business technology services sector, focused on buy and build strategies. And we are thinking about lower mid-market as, because that's where we focus, as sub 50 million EV, translating to EBITDAs of 1 to 5.
Excellent, thank you very much. And on that note, can we have the poll results, please, and to see what our audience thinks as well? Oh, that's the slide that should come next. Do you see that? Well, while we sort that out, I can see on the iPad that 37% of you think that it's between 50 and 100 million. 20% think that it's between 100 and 300. Oh, here we go, it's now. And then less than 500, 19, and then it's equal 13% think that it's less than 50, and all of the above. So it looks like we have the majority goes with what Sean said. On that note, if we move into the discussion on the actual mid-market as a squeeze middle, its center of attention, and based on what we discussed in our pre-panel calls as well, if we look at actually now the slide as well, we'll see that mid-market investments, and with there we broke them down within S&P Global Market Intelligence, really in 3 buckets. But if you look at the lower mid and then mid-mid, tend to enjoy a lot of capital inflow. So that goes to my question about deal sourcing in the mid-market, especially when you operate in, I guess, on the lower side. So how important deal sourcing origination for you when you're in that space?
Do you want me to start off, Olga? Yeah.
Yes, if you could
yeah,
kick us
I
off,
mean,
Sean, yes.
I'm slightly in danger of being an ungracious guest here because these are Olga's figures, but I personally love the symbol stats for defining the market, and I think it's just good for perhaps people in the audience who are less familiar to understand the size of the market. Between 25 and 100 million, and there are approximately 60 deals done a year in the UK, and that's a very good proxy for the market that we do, so we think very closely about that. And interestingly, about half of those are secondary buyouts. We saw the chart earlier. Even at our end of the market, in that 25 to 100, half of those deals are secondary buyouts. CBPE as a business predominantly does primary buyouts. 80% of the deals we've done in the last 10 years have been primary buyouts, just for context. And that goes the whole strategy about origination. Origination can be a bit like motherhood and apple pie, you know. It's a good thing. Everybody says origination is a good thing, and clearly it is, but it's not a guarantee of success. When we think about origination, we think about what I call the Tower of Deals, and Harry had that up today, and it's quite rare to see that, but I think that's actually the guts of private equity, certainly the guts of lower mid-market private equity. What I mean by the Tower of the Deals is in 10 years' time, as Harry did for back in 2008-9, you can see every deal that was done in that vintage, and it's ranked from the weakest performer to the strongest performer, and he had what he called his gold stars at the 4 times plus. And when we think about origination, we're thinking about disproportionately trying to target investments that we think are likely to be in the top end of that. And that, the first principle is not all origination is equal, not all meetings are of equal quality, and the key thing for a lower mid-market fund, such as ourselves, 16 people based in London, is prioritisation and sifting. And very simply, we think of a triangle. What are we originating? What do we think and know about the subsectors that they're in? What's our track record like? How much do we like them? And there are many that you won't like, so you won't even meet. And then we think about a third bucket, which we call the deal situation. There's about 12 sub-buckets of that. But to kind of get beyond, you know, the first post, it has to satisfy all of those criteria. And that narrows our funnel down very, very effectively, very, very quickly. So it's effective origination is, I think, the key to lower mid-market.
And just to build on that, I think that, to Sean's point, everyone probably has origination function in some form, be that an allocation of portion of time of the investment team, or increasingly commonly, you know, a dedicated team, 1 person or more people. But I don't think we didn't say to our LPs when we were raising our fund that we're under any illusion we're going to complete, definitely not 100%, or maybe even, you know, just it's going to be 1 or 2, which are completely off-market originated transactions. The origination piece is more about, as the market has matured, you need to build angles, you need to understand sectors better. It's about doing that. It's about the sort of front end, that sort of top of funnel piece. And so where we, for example, with us, we have one partner who's directly just focused on direct origination, and that's for continuity purposes while the investment team gets busy. And so it's about understanding themes and subsectors and getting to know businesses within them, so that if they do come to market through an advisor, then maybe we've met them earlier, maybe we have an angle or an understanding or contacts or connections, which will help us in a process.
So about 15 years ago, you know, deal origination was making sure that you were going out and speaking to the accountants in the local areas and having coffee with them and making sure you're sort of you're going to get the IMs through the door. Through to now, I think when we hear deal origination, I mean it's just simply it's an expectation around making sure people are in front of the potential acquisitions they're going to be going for. I mean, I think if I would add up what the proprietary deal flow that everyone says they have, I don't know what corporate finance is doing, but we do think. Again, expecting people to focus on what they want to do and ensuring that when things do come up and are intermediated, and I think most things still are to some extent, they're at the front of the queue and they understand what they're going to acquire and have a particular position around the soft issues.
Excellent. And do we have an opinion from you,
Sure.
Oliver?
Well, we've invested heavily in direct origination, so 9 of our last 12 transactions either had no competition or limited competition. But we have a big advantage because we're looking at particular challenges that we're trying to find businesses that have got a solution to address those challenges. So it could be obesity or it could be some other big long-term trend. And then we're looking at the solution that's going to address that challenge. That gives us a big advantage.
Excellent. And I have actually a few questions from the audience. Thank you very much. And that two of them actually lead into our next topic about the competition, and we mentioned that as well. We've seen, and we discussed it in our pre-panel call as well, the recent trend of mega funds going into the mid-market space. And the question from the audience overall is, in light of added competition, do you think there will be consolidation in the UK mid-market? And more specifically, there was a question to you, Sean. Have you had conversations about this?
Is somebody offering to buy us for a I'm not sure. Well, look, there is increasing competition. You can't regulate it. I once sat at a panel in France 3 years ago, and they wanted to limit the number of people competing in the market, which I thought was an interesting dynamic. But no, there is competition moving in, and actually, that's in two particular forms. You're seeing larger funds scale down. Shani gave a very good explanation of Living Bridge's sort of family of businesses, and I think it works for them because there are no gaps. I think it doesn't work so well if you've got somebody at this end and then a big gap, and the junior team who've been hired. And I think it also works really well for somebody like HG and the Mercury Fund because they have, fantastic domain knowledge within technology, and it works well for them. And perhaps if more of our proportion of our investments are in technology, I'll be more worried about that. We're relatively light on technology investing. But I think there is absolutely a fundamental place for your highly motivated, high incentivized, low mid-market group who has a track record in subsectors, has proven that they can work with people to change teams, invest in systems, and forms that bond with management teams to go on that journey.
Great. The second question also relates to the competition, and I was actually curious if this is going to come up, the topic of Brexit. So do you think the UK market will become less competitive as a result of Brexit, and we will see more firms be unable to actually raise funds? Do we have, Oliver,
clearly the withdrawal of the EIF has had a big impact already on a number of funds. I think British Business Bank is looking to step into that gap. But that's one of the biggest changes to adapt to. Who knows what will happen in 6 months' time? We shall see.
Yes.
It also, of course, takes some time to play through because there is a wall of capital out there from funds which have been raised, which need to deploy. So even if there's a pause, which often happens around uncertain periods, there's still capital to deploy. And certainly in the lower mid-market, we're an entrepreneurial culture. There's still large swathes of businesses looking to transact. So I anticipate, and I'm no expert, that there'll be a temporary slowdown while people get a bit jittery about the uncertainty, but then things will carry on.
Yeah, and then do you think, following on from that, the commitment of the funds will be less if there will be a challenge of raising them? Do you think that might be a new trend coming out of this?
I mean, it depends on it depends on returns, doesn't it? I guess.
Looking at anyone.
It's difficult to say. I mean, one of the challenges that we have is we manage mandates for many different people in there, and there's quite a disconnect between what some people in other countries think of Europe. I don't like to market time making primary investments. The best time to be investing is usually when everyone's coming away. So, and the UK remains, for all the reasons we know, a deeply attractive long-term private equity space. So I don't see that happening, but the next few years will be challenging because this is the great unknown. What opportunities it comes up, I don't know.
Yeah, thank you. Moving on to the next question that I had in mind for us to discuss, and we talked about it also in our call. The lower mid-market tends to obviously generate the assets that are not formed that well. And that doesn't mean that the holding periods by default will grow. Is that the trend that we started seeing it already, but is that the trend that will get stronger? Is it the trend maybe that will go and disappear, or is it something that you think will prevail?
So let me kick off. We're in the low market, often investing, as Sean says, in primary buyouts. So we're first-time institutional capital. What comes with that is, there's great businesses in there, but they often need, I hate the word, professionalization. So maybe some investment in the finance function, information coming out, investment in technology and infrastructure, and investment supplementing management or transitioning management over a period. And so those things, that can take time. We try and do a lot of that work up front. So you're trying to identify what needs to be done, get that in your 100-day plan, have the management additions in place at the time you transact. The other piece, I think, which increases hold periods is buy and build strategies. So when you're doing a buy and build, you want to be able to execute those and then benefit from the accretive profit growth that you're getting from those acquisitions. And certainly, once you've got something which is working, a buy and build machine which is working, if there's the opportunity to continue to deploy capital into that in a known quantity with a known management team that are good, then it can be the right decision to do that. I think the flip side is, and I always have this well taught by my alma mater Inflection in the back of my mind, is that we haven't achieved our returns until the money's in the bank. So always an eye to exit the evolving exit environment when it might be sensible to take that early exit as well.
I think it's a very good point. I think there's good reasons for longer hold periods and bad ones. And I think having a strategy of backing those is a very good one. But of course, often we see the hold periods being long because, again, things don't work out and you can't sell them, or there's a crisis in the meantime. I think that portfolio management piece is important. We would like to see, and I think the mid-market or low mid-market offers the greatest opportunity for really having the high alpha, high generating returns, and those are the things that can really turn the needle on ultimate performance. But, and there's a big but to it, which is that from our perspective, seeing some of those things come back early and reducing that perceived risk and getting cash back is important. So someone who says we're just simply going to back everything for long term is more challenging from our perspective.
Yeah, Merrick will have looked at a lot of studies. Generally speaking, if something is 7 years old in a low mid-market forward, it's probably underperformed. Yeah. There are rare exceptions. We had an asset for 9 years and made 20 times our capital. But as a general point, I would also say ride your winners. We've sold, out of 37 businesses, we've sold 5 have made more than 7 times capital. If I think about the value accretion in the last 12 months of those, that was very significant. But you have to be confident. You will get lots of calls from LPs to crystallise those, and you have to have the courage of your convictions to hold those over that period of time. But I'm a believer definitely in riding your winners.
Or sell on forward profits, given we're selling into a very competitive market.
You're sounding like a corporate financier.
Yeah, you can always do that. And I guess carrying on from the LP perspective, so we mentioned some of the challenges, but overall, is there a growing concern with the growing holding periods, or is it something that once you talk to the GP and understand more, once to Sean's point, so there's a level of conviction involved, then you kind of take a step back and wait for the asset?
I think my greatest concern is that hold periods will be very long from now on. On average, it's been, look, being a GP is hard wherever you are, but it's been relatively easy riding an up cycle, and I don't think many of us would expect it to be good going forward. So, I'm not being kept awake at night by, if anything, it's probably by debt structures in there being, GPs will retain the keys, but I expect things won't be as good, and people are going to hold them for longer, which will have an impact on ultimately on gross returns in there, and then obviously the fees and everything that goes with it. So I'm expecting to see ultimately lower net returns, and that probably being the biggest component of it.
Just one more thing to add. We've seen this trend over time, and there are situations where an exit is just not the right thing for the business to do. So on the back of that, we've raised an Evergreen Fund, which is clues in the name. There's no requirement for an exit, and it's more of a yield-driven play where the business isn't ramped and sold. It's a longer-term alignment with management to achieve something over the longer term.
Excellent. Thank you. We have actually quite a few questions from the audience on some separate topics, but I guess it can go together with the holding periods and the growing concern about that. Would valuation, you think? So when you're buying an asset and when you exit an asset. And overall, the question from the audience that we have is how have valuation multiples changed in recent years in the mid-market?
Well, the simple facts will tell you, if you look at they unfortunately cut the data on the pricing slightly differently to the volume, so maybe the S&P are going to improve on that. But they look at 10 to 100 million, and the facts are that's gone from about 7.5, 5 years ago, and it's been in the mid-tens for the last 3 years. That's an EV/EBITDA multiple. I always say to our investors, I think that's actually diluting down, because the 10 to 25 million EV deals will typically be smaller multiples. So actually, if you look at what I call the true low mid-market, 25 to 100, that's at higher prices, and higher prices are definitely the order of the day. We possibly contributed to 2 or 3 things we wanted to do this year that we haven't, because we walked away on price. It is still possible to find great opportunities. The average entry multiple for the 5 businesses we've done in the last 2 years is just shade under 8 times, and the average first-year growth has been 30%, and we're kind of content with that.
Yeah, thank you. I guess that takes me to the next question from the audience that also ties into our other theme of the discussion about value creation. So we heard earlier as well from another panel a very interesting discussion on the overall value creation, and I'm curious to know more about what does it mean to create value within mid-market, because that can also be a very specific skill, I guess. And the question from the audience is, what creates more value when an investment underperforms? Exiting early or continuing to work and turn it around? So I guess, Nicki, to your point, to continue building it out and investing in it.
I think the key challenge of, just back to the previous question, of multiples going up is there is an opportunity to sort of buck that trend and do more business building. So we find ourselves very often putting in the first finance director, first marketing director, and a team of 2 can quickly become a senior team of 6. That's not easy. That takes quite a lot of selection, and we find ourselves in the first year or 2 doing a lot of that hands-on business building. But as a consequence, you can buy assets at a lower multiple. We're buying at sort of 5, 6, 7 times multiple, but these are much less formed assets where there is a lot more hands-on work to do. And that tends to mean the whole period can be a little bit longer, unless you're going to do a buy and build strategy to accelerate that approach.
Yeah. No, that makes sense.
And I think the other thing I'd add, which is to Sean's previous point around multiples, is if you are doing buy and build, which is a core part of what we do for value creation, then generally you're buying smaller assets than your platform assets, and they will fall into this less formed. You might be just buying a book of business with no management at all, for example, and they definitely are available at lower multiples, so you can, in some sense, average down your in price.
Being slightly controversial, I think that in the lower end of the market, most of the value creation is actually around buying well, and it's around ensuring that you're targeting the businesses that you want to do, paying well for them, and backing really good management teams and making sure they execute with that. It's different when you move up into larger ones where pricing is much more thin, and a lot of the effort has to go into bringing other skills to bear. So I think that has changed over time, but I'd still prefer to see that aspect buying well in this part of the market.
Excellent. Any other thoughts from anyone else on this? Okay.
I guess the other thing on multiples in terms of where we're buying at and where we're selling at, and you don't want to be building large arbitrage into your returns modelling, deluding yourself. But when you are buying a business which is, primary buyout and it has, imperfect information, you're spending a lot of work to understand it. When you're selling it, of course, it's, part of when you're selling it is you are providing it, I'd say sort of perfectly packaged up with all of that information.
But
and
almost.
And so it may have been presented with 10% recurring revenue, but oh look, 50% of repeat type revenue also looks recurring to me, so it will be presented with 60% recurring revenue. I exaggerate to make a point, but that I think there is definite value creation in presenting a business well, presenting a business with good information so people can understand it easily.
Of course, the other problem when we talk about valuations, what's it off? I think we're really into sort of the EBBS territory, earnings before bad stuff. forward numbers being used. So I think, and that's the problem at the moment. It's at this you're applying cyclically high multiples against quite often cyclically high earnings and on a forward basis. So, what could go wrong?
Exactly. There are opportunities are endless or not. I guess to kind of finish off on the value creation topic, so what would you say in a few sentences are the do's and don'ts? And we've spoken about the do's a bit, but I guess what are the don'ts when it goes to value creation in mid-market, specifically lower mid-market?
People. Management has been covered several times today. Make the big decisions early.
Mm-hmm.
When you work backwards from what the management team will look like in 3-5 years' time, it's better to overhire early and take the thorny issues and confront them in a proper way than it is to defer those and then have bigger problems dealing with the issues 2-3 years down the line.
That makes
And
sense.
I one sort of rider agreeing with that is I think it's very important. So don't just turn up to board meetings. Be a visible presence in the company. I think it was Mark Bond earlier was talking about meeting people below the board meeting. We think it's important that we meet managers below the board level. We have meetings with them. Then you can often tell what's really happening in a company, but also, to his point, understand the talent for the rising through that business in the future. Because almost inevitably, the business that you present at whatever time it is in the future, 5, 6 years or whatever it is going to be a different management team because some change will have happened, and really understanding the guts of the business is do it. So don't just be boardroom capital, be active and visibly present in the business.
So very good. Nicki?
It's unfair going last in these situations.
You can disagree.
No, I don't disagree. I firmly agree. I think I used to call it, when I ran my own business, I ran a technology company for 5 years in the US, and I used to say ripping the Band-Aid off early. So, if you have a gut feel, and gut feel when you need the evidence to back it up about a manager, and often, unfortunately, it's the finance director, then it's probably going to be right to change them, and you're going to if you waste 6 months of a 3-year hold period, it has a big impact.
Yeah, of course. That makes sense. It doesn't look like we have any more questions from the audience, and our time is running out. So I guess to end maybe on more positive and interesting note as well, in 15 seconds or less, in your opinion, what is one of the best things about operating in the mid-market space at the moment?
All the liquidity ahead of you. You've got larger buyout funds who are on the phone all the time for your best assets. We've IPO'd 3 businesses in the last 18 months. I think there is interest in the IPO market for genuine growth businesses in that 150 to 350 EV space, and then there's still trade options, particularly where there are synergies. So the liquidity ahead of us is the best thing about being in the lower mid-market.
Less competition, less auctions, but not none.
Okay. Nicki, so?
Operationally, people and relationships. It's undoubtedly more important. If you're buying off a founder-owner and you're buying their baby they've spent 25, 30 years creating, and you're coming in as a partner to support them, it becomes as much about that. I'm not saying the numbers aren't important, but as much about that as your headline price and structure and what you're doing in a spreadsheet.
Yeah, I go back to Sean's original point. I think it's the sheer volume of opportunities in the market and the imperfections that are there. So I think all of these intangible aspects that many highly competent people who are entrepreneurial themselves in nature can identify this. I think it's just a very fertile ground that will remain that way.
Excellent. Well, thank you very much. I'd like the audience to thank our esteemed panel as well with me. Thank you for your time.